Wait, we're live?
Blair's live.
Blair, you are live.
Good morning. My name is Blair Guru, co-founder and managing director of Mercury, an early stage venture capital firm headquartered in Houston with a focus on backing entrepreneurs across middle America. 18 years ago, and I can't believe it's been that long, my co-founder Dan Watkins and I launched Mercury. We've also helped launch many of the startup development organizations in Houston. Our firm works tirelessly with organizations such as HX Venture Fund, Han, Rice Alliance, and the ION, and many others to help Houston realize its full potential as one of the most diverse, collaborative, and innovative cities of America's new age. I'd like to start by thanking Steve Case for a terrific and uplifting keynote interview by Houston's own rock star, Gina Luna. It's just so great that Houston can now attract that type of talent to share their experiences about building tech ecosystems elsewhere. And I now have the pleasure of moderating our next panel, Venture Capital, High Octane Fuel, Driving Returns and Innovation Amongst Institutional Investors. Today, we have over 2,200 confirmed attendees, making this the largest venture capital event in Houston history. Of those attendees, about 400 are venture fund managers, and I know many of them will be really interested in learning from our next three panelists. But before I introduce the panelists, I'd like to ask that HX and HX Vendor Fund send out a few of the polling questions to the audience for us to utilize. And with that, I'd like to introduce our three panelists. First is Allison Thacker, President and Chief Investment Officer of Rice Management Company. Next up is Mike Pia, Chief Investment Officer of the Texas A&M Foundation. And last is a friend and former boss who gave me my start in the venture capital industry, Paul Hobby. Now, Paul serves two roles today. The first is he is on the investment committee for HX Venture Fund. He helped launch that organization, but also he's founder and managing director of Genesis Park, a Houston-based private equity firm investing in innovative, high-growth, and tech-enabled businesses. So welcome, panel. And let me start with you, Allison. Obviously, we are knee-deep in COVID. The markets have recovered to a degree, but you're managing a portfolio to meet the current and future needs of your university. And a lot's been said about university budgets and how hard that is now. How do you prepare your portfolio to withstand severe market instability, such as the recent financial crisis? And how do you think about that from a venture capital perspective?
Morning, Blair, and thank you for having me join everyone today. So the Rice Endowment, I think, is very typical of a large educationally oriented endowment. So we manage $6.5 billion on behalf of Rice and fund 40% of the budget of the school. So Rice really doesn't function without that distribution from the endowment, which will be about $330 million this year. Which means that endowments and foundation portfolios generally have to balance two incredibly important challenges. One is providing stability to their institution because most of our costs are often headcount. So we cannot adjust cost basis very well without huge human cost. And the second thing is that we need to drive appreciation over time so that we can keep up with purchasing power preservation. And I think that is really where venture fits in. So I don't look to the venture capital asset class to provide downside protection. Other parts of our portfolio do that. Venture is a growth driver. And so what it needs to do is outperform, and over long periods of time, say 10, 20, 30-year rolling periods, Rice has had incredibly great results out of our venture portfolio. We got into venture in the 1990s, far before we got into the private equity or other private asset classes. And it has generated an incredible amount of wealth for Rice over time. It's about a $700 million portfolio today. However, we're always trying to consider how is venture as an asset class evolving. And I would say it's grown in terms of its percentage of our portfolio over the last 10 years fairly significantly for two reasons. One is venture funds are lasting longer. So companies are staying private longer, thus the average length of time before we get capital back has extended. And then the second thing is managers continue to grow their offerings into the later stage area. And so that is another reason that our portfolio has grown so much over the last 10 years.
No, that's great. And so next up, I'd like to hear from Mike. And Mike, you were recently joined Texas A&M Foundation in 2020, and the press release stated, the hiring of PIA comes at an important time as the foundation investment team seeks to implement forward-thinking endowment management strategies throughout and beyond the period of market volatility during the COVID-19 pandemic. And prior to the A&M Foundation, came from Texas Teachers. We had a great career there, but talk a bit about how the foundation's different than the Rice Management Company and that endowment as far as where its capital goes, and how do you think about balance, especially for venture now?
Great, Blair. Thanks for bringing up that press release. I'm sure that was forward thinking in itself. Look, really happy to be here and provide some insights, hopefully, to the crowd. Maybe not as exciting as Steve, but I'll do my best. What I would kind of tell you, and I'd key off of what Allison mentioned, the difference between the A&M Foundation and the Rice Endowment is that we're a private foundation. We are not part of the university system. We are funded purely by donor gifts, and we do not support the university operations. We are implementing donor intent in terms of, and most of it is through academic, whether it's scholarships or professorships and chairships and those sorts of things. So we, as an organization, have some advantages relative to maybe some other university endowments. Is we can control our own destiny with regards to our support and our spending. We, like the Rice Endowment, want to preserve purchasing power. And interesting enough, we've been going through an exercise with our board, who includes Gina. So we've leveraged her. We had 3 sessions in January, so we're really wearing them out. But talking about, what does maintaining that purchasing power really mean? If you think about just price inflation versus tuition education inflation, there's a big difference between the two. And the dialogue we're having with our board is, well, how far do we want to bridge that gap? We can't bridge it all the way because that number is way too big and would be irresponsible for us to seek a target return that high. But that's sort of the difference between what we are doing at the foundation versus the endowment. And part of your question is, hey, what am I bringing from a big pension plan to a much smaller endowment? And for scale for the audience, Texas Teachers right now is probably 170 billion or so. I haven't been there in some months, haven't looked it up, but it's probably the largest investment pool in the state. It's not in the nation, it's in the top 5 from a public plan perspective, down to the foundation, which we're at 2.2 billion at the end of 2020. So the scale there is way different. But there are, if you look at my background, I do not have the traditional background of investment management. I flew airplanes for the Marine Corps to start my career, was an engineer at Lockheed Martin Aeronautics, finally found my way to finance. You got to learn lessons learned. And that's one of the things that Steve mentioned as, when he is early on in AOL and now his current position on looking back, the lessons learned I've taken and I will take from Texas Teachers is a balance matters. And being intentional before crises is how you survive crises. And so you have to structure your portfolio through a thoughtful asset allocation that incorporates this concept that, hey, every once in a while, the market has a fit for whatever reason, whether it's economic or pandemic or something else geopolitical. But with regards to venture, and I will hardly emphasize what Allison mentioned, is venture is about growth and appreciation. That's the role that venture plays in our portfolio. And it's about optimism, right? So we want optimists, and we're going to go invest with optimists because they believe in what they're doing and they're going to find growth. But we also have a part of our portfolio that thinks about downside and is a little more dour in their outlook of the world. And those investments and those people are designed to help us survive the crises. And it's really, when you think about credit versus equity investors and, their outlooks and how they underwrite things, basically that's what we're trying to do.
No, thanks, Mike. That's perfect. So Paul, my next question is really, we've talked to two institutional investors, and I know with Genesis Park, you've got institutional investment, also family office investment. At Mercury, we're seeing kind of a phenomenon in Texas right now where a lot of family offices who had massive exposure in oil and gas and real estate, post-COVID, they're looking to diversify. They're looking to get into tech and get educated by that. You and I have talked about this in the past. I mean, have you seen these changes over time? With non-institutional kind of private capital kind of coming in and out, and how do you, what kind of words of wisdom can you give out there, especially to fund managers looking to raise capital in Texas from family offices? So I think you're on mute, Paul.
It's a great question, Blair. You were there more than 20 years ago when we started Genesis Park. The interesting feedback we got from a lot of people who said, we just don't know why Houston doesn't have venture, PE, alternative asset fund presence. Now, again, so much of that has changed and all for the better. They certainly had upstream oil and gas kind of funds, but the operative thesis at that point was if you wanted, high beta alternative illiquid exposure in Houston, it wasn't that you didn't have capital or risk appetite. You had a neighbor with a drilling deal, and that's where those dollars went. And so certainly we're through that for all sorts of reasons that we don't need to belabor. So I do think that people are realizing that, public markets, you're not going to beat the index for reasons we can cover another time. You have to be exposed to alternatives. How do you want to do that? And to have a lottery ticket down in an environment where it can sustain losses, and that's sort of the painful reality of venture, is that there is a mortality rate in this asset class, and maybe that's why Genesis Park doesn't do it. But so in that sense, I'm objective. We all have our guilty personal guilty pleasure personal venture portfolio, but I've been an industry observer here for a while. The note that I think most people have heard me play before, but to the extent anybody hasn't, I'll do it again. We have, and I can take you through the math because I've done the pre-Quinn pitch book, as much math as you can do. We have between $2.5 and $3 billion worth of venture allocation that is Houston domiciled today. Now, we don't have that many quality venture opportunities in Houston, so some of that money is going to leave town. But the problem is that over time, most of it leaves town, and the reasons are various. But one is that consultants, gatekeepers, fund of funds, those tend to reinforce patterns. They also isolate trustees from liability, and we ought to be not legal liability, but accountability for results. They create a buffer, and there's some value in that, I suppose. But those people reinforce patterns. They push money back out to both coasts. And so what do we do gradually to change that behavior? Well, HX actually has one answer, and that is, use Houston dollars to put Houston in the conversation, to get the attention of managers and fund allocators and open their eyes to what's going on in Houston. And again, that has worked in other cities, and knock on wood, it seems to be working with HX here. I don't think we have enough data to say for sure, declare victory. The other methods for doing this would be for institutions to consciously amend their investment policy and say, we have a local impact factor in all this. And the fees that you save on the front end with your consultants and fund of funds and gatekeepers will more than cover any DCF deficiency on the backside of that investment, I think, anyway. So again, it's more about growing managers, getting existing managers to open Houston offices, using the leverage of Houston dollars to do that in a responsible way, because everybody has a fiduciary duty. I get it. So that's my take.
No, that's great, Paul. And so Allison, Rice was one of the first committers to the HX Venture Fund. And so talk about how HX Venture Fund kind of serves that purpose that Paul was talking about for you, and also any changes in strategy as far as venture fund direct allocation as it comes to venture, just versus venture funds specifically.
So over time, the endowment has believed that you partner slowly, and as opposed to, what is that, getting married fast and regretting at leisure. We tend to study things a lot before we partner with institutional investment partners, because we want to be there. When we commit to a fund, it is a commitment not just to this fund, but for the next two. And so that requires us to have confidence about your business for, say, 20 years. And a lot of the time that means we don't do fund ones or fund twos because we are really looking for stability. Additionally, our team on the investment side is only about 10 people. So if you think about the management of those relationships, there's a limit to how many partners we can have and to how small of a commitment we can make to a manager. So that means HX Venture Fund fit a very intriguing niche for us, which was we could due diligence the team running that fund and have them go out and do a lot of the legwork to try to identify early stage firms, spend more time with them, decide who is really good and who truly mentors the entrepreneurs afterwards, making their companies a success. And so in my view, I kind of think of that team as a outsourced part of our team where they're managing a piece of our allocation that's difficult for us. And hopefully they'll be out finding future farm team members for our portfolio.
No, that's great. I know Sandy and Guillermo and that team do that a lot, not only for you guys, but for corporates and others. And that's one of the things that's worked with that model in Detroit and Cincinnati. Mike, back to you. If you think about the venture firms that the foundation has invested in, that you've inherited, and as you go through and rationalize that, you're now in a position where post-COVID, what we're seeing is that talent and capital that was very much coastal, right, for the last, 30, 40 years of venture is now starting to all move inward, right? So for those of us and lots of other people that are watching this, we've been kind of beating this drum for some time. Are you thinking about reallocation at all from that perspective? Or do you think you want to see if that sticks for a while? Because there's obviously coastal firms that will take advantage of deals in the middle of the country, much like, Steve Case talked about. But it's kind of an interesting phenomenon that's happening right now. How do you think about that?
Great question, Blair. And what I'll do to start that conversation is kind of think about what I think are the three pillars to active management. The first we already touched on, which was asset allocation. The second was security. The other is security selection, and Allison touched on that, and we can do that a little bit more here in a second. The third, I think, is portfolio construction. And really, that's kind of what you're talking about here is, hey, how do we think about portfolio construction? And I agree, our venture portfolio, we were new to the asset class. Going direct to, instead of using funded funds, really started in, I would say 2017 or so. So super early relative to other university endowments. So our current portfolio has a lot of first-time funds. Some people call them breakout managers, emerging managers, whatever term you want to use. It's super early in that regard. And if you recall back to the first topic about balance, I believe in balance. And also data. So Paul brought up data. The data would suggest, and I learned that this at Texas Teachers as well, is hey, there is persistence of returns with those firms that are clearly been established. They've been there for a long period of time. They figured out the model not only to find good investments, but also for the firm to transition over time and allow succession and new partners to join, and the firm to be a going concern for many, many years. Getting access to those firms, very difficult, and especially for a new entrant. And so from what we're doing from a portfolio perspective to add balance, we're going to do, the only way for us to get access there is to pay for it and using a fund of funds type model that has those existing relationships. But we're still going to remain about half of our portfolio from a venture perspective focused on new managers, the breakout managers, and we're geography agnostic. What we want are firms that have experience, can tell us what their story is and what their edge is, and this goes down to the security selection piece of and what Allison talked about is we want to partner with people. This is not a transactional business. We want long-term relationships. And so it's going to take us a while to get to know somebody. And if they have a strategy and a demonstrated sourcing network that makes sense in the middle of the country, we'll consider investing with them. But it's too difficult for us to kind of think about, hey, X% to the coast, X% to this location versus the other location. We're resource constrained, and our ability to carve up the portfolio is, in that regard, is just too difficult for us to manage.
Yeah.
As of December, we now have a team of four investors on my team, right? So I hired somebody in December, small team across, and we're active in lots of private equity, we're in real estate, we're in energy, credit, the whole team. That's what we're doing.
No, thanks, Mike. That's great. So Paul, in your role being on the investment committee of HX Venture Fund, think about some of Mike's comments as far as portfolio allocation and so forth. How have you been either surprised or not surprised by the quality of venture firms that are pitching HX Venture Fund, those that are on the panel, or excuse me, leading panels? Yeah, what's been your overall exposure to that, and how do you think about portfolio allocation from a fund to funds perspective?
I mean, I've been very pleased, and maybe that's just a tribute to Guillermo and Sandy and Gina, because they're just personally irresistible. But the lens that I have looked at this through is, economic development of any kind happens from strength to strength. And so a lot of the panels today, I think, are well designed. We obviously have energy transition relevant knowledge. We have an opportunity in digital manufacturing that is sort of manifest and obvious to those of us who pay attention. The med bio side of the equation, again, we've talked about that for years. That's there for the taking. So the people that tend to invest in areas where Houston should be strong because we have component parts, we're just missing a few. Those are the ones that are most attractive to me and maybe to the rest of HX Venture, but I can't speak for the rest of the investment committee.
Yep. No, that's great. One other thing too, for anyone really on the panel, we're obviously in this frothiness stage with tech valuations, right? I mean, leading up to COVID, there were lots of kind of eyebrows around WeWork, and then it happened. And then you saw, a lot of capital kind of just being dislodged there. COVID hits, everyone's trying to figure out what happens. And then we just came out of the largest amount of venture ever raised, right, in the last 20 years, as well as being deployed. Now, most of that capital wasn't necessarily in Series A's and early stage. That actually went down, I think, by 10 to 12% from a recent Silicon Valley Bank market report, but it went into the concentration into these unicorns. How do you guys think about that? Maybe Allison, starting with you, because obviously you've got exposure to that with some great funds that Rice has invested in. And does it worry you, or do you think this is sustained? I mean, obviously, very lazy monetary policy, cheap money out there. What are your thoughts there?
Yesterday, a venture capitalist told me about a company that did 20 million in revenues run rate last year and just was given a $1.6 billion valuation. I don't know what to do about that. So Blair, before I came to the Rice Endowment in 2011, for the prior decade, I worked out in San Francisco running a tech fund, which invested primarily in post-IPO and in leading tech companies. And I'll tell you, I was just looking at it this morning, thinking about it. So if you bought Cisco in 2000, late 99 or 2000, it peaked at $77 in early 2000. It's at 47 this morning. That is not because Cisco is not a great company and still not a dominant leader. So I truly believe price matters. And I say this is probably the thing I lose the most sleep about right now is I'm not sure if price is mattering in processes right now as much as it should. On the other hand, when we look at the companies some of our experienced venture partners are backing, they have seen phenomenal fundamental accelerations in their businesses. COVID's actually been really good for some people. So while it's been bad for retailers and energy companies and many individual people, it's been phenomenal if you're Zoom. And so I think we struggle with this and really worry about it. Rice is right now at our most conservative asset allocation state because we do see the US market as extremely expensive.
Yeah, absolutely. Let's transition, away from that for a second and think about ESG. Obviously, COVID has put ESG kind of front and center with all the chain of events that we don't have to kind of dive into. But again, as a fund manager, we're seeing that ESG and impact needs to be woven into everything we do. We're hearing that from institutions. I think obviously the public ones and pensions may drive a lot of that. Mike, as you guys are forming, again, these new strategies around the foundation, how have you guys thought about ESG broadly, and or is it more of an investment strategy around, say, the E? But just talk to that a bit and how you guys are thinking through that.
Good question, Blair. And obviously, ESG is on a lot of minds, and it's garnering a lot of attention. But look, what I would tell you is, as a foundation in our totality, not just the endowment piece, we can have the greatest impact on the world by focusing on our core mission, which is providing support to the university per our donor intent, and which, again, as I mentioned in the beginning, which the large part of that is endowed scholarships, right? So, by doing that and maintaining our purchasing power and providing as much support to students as possible, we'll allow those students to go forth, prosper, and shape the world individually. And I'm truly, we're 2.2 billion, 4 people. It's really going to be hard for us to make a real impact on the world, but we can do it through the university. And so that's how we're focusing on ESG. We, of course, are paying attention to trends. But what I would say is we want to stay logical and thoughtful as an investor, not allow passion and emotion on various issues to overly influence us. We want to be part of larger structural trends. Energy transition is certainly one of those things for us to think about. But we want to avoid areas where enthusiasm exceeds value, right? And I don't have an example for you on that, but those are sorts of things that we're kind of thinking about. That being said, we're going to invest with responsibility and with the Aggie core values in mind, with moral certainty and a happy heart that we are partnering with like-minded firms with a good chance of achieving our goals together. And usually that's, when we're doing active management, you want alpha and returns. So from a firm perspective, it only makes sense. We want to partner with forward-thinking firms, not only on how they deploy capital, staying ahead of the curve and understanding where the market's going, but also how they're developing their teams and making sure those teams have diversity of thought and engagement and skills, right? And that's the same thing we want to do within our team. Obviously, it's a small team, so there's limited capability for us to be super diverse. So that's what I would tell you on that. If we were to make any shifts in our portfolio that somebody might construe as ESG focused, what I would tell you is that's more about diversification, return and risk.
Yeah, more from an asset perspective.
That's right.
Yeah, and I think that I really appreciate your comments because I know a lot of managers on the venture side are trying to think through this, and they want to talk to as many institutions as possible. Allison, how's Rice viewing this? Obviously, you guys have a lot of number of direct investments out there, but how are you thinking about decarbonization, energy transition, and then ESG more broadly?
Paul, did you have something you really wanted to say?
No, I was just going to make a distinction between passive ESG, and I think we've all practiced that. You remember Google's original slogan, don't do evil. I think we all take passive ESG as table stakes, but the question here that's interesting is the active ESG, and that was really the question that Blair was asking you. Coal is dead not because we had a coal tax, but because we had technology development and fracking, and because the financial markets have refused to finance new coal plants for the last 15 to 20 years. There's been a de facto moratorium. And it's nice when markets and technology solve problems so government doesn't have to. So I think that's where Blair was going, is active ESG.
So this is an active area of debate within our team and our board. So I do like to tell people the endowment in itself is a social enterprise oriented pool, right? As Mike said, we are here to lower the cost of attendance at Rice for families who need it. And I think some of our great performance is what's enabled Rice to launch the Rice Investment, which substantively reduces tuition for families of even moderate income. But, when I look at active ESG choices, our view has always been that good stakeholder management is the best form of risk management. And so what you have to do is try to encourage your managers that you select to view that similarly, right? And I think decarbonization is something that there is a tremendous amount of scientific work going on at Rice University in our labs. This is a problem that our scientists and our thinkers in Houston who know the most about energy supply chains and fundamental molecule science need to work on and come up with economic solutions. Because Paul's right, to really be adopted and adopted quickly, there need to be not just the feel good, but also the economic incentives towards this. And so we are big believers in that. I think some of the moves that we're making are through supporting research at the university, but secondarily in the innovation district next to the ION, recruiting Greentown Labs to come to Houston, which so many people in Houston have been a part of. But we are also contributing to that kind of through real estate, which is we need more companies working on this issue and finding economic solutions. And then we need Houston companies implementing them because they sit at the heart of the industry. And I think the nation's going to need their participation to be successful.
No, Allison, that's great. I know there's a number of venture funds on the call that aren't from Houston that may not have met you or your colleagues at Rice. Maybe speak a little bit about Rice's direction and the leadership you guys have taken in developing the ION and so forth.
So it's intriguing, and it was funny. A lot of what Steve Case said really resonated with me. So our Rice University board has had conversations intensely over the last 5 years. And I think if you look at the history of the institution of Rice, which is just over 100 years old, our fates and fortunes have been very tightly intertwined with the fate and fortune of the city of Houston. As the city of Houston has grown, Rice University has prospered and grown as well. And so one of the things that we've been talking about is how do you help Houston avoid the Detroit problem, which is a single-handed or single-minded approach towards a couple of industries is probably not enough. We need more jobs for Houston. And if you look at Houston, it's vibrant, it's diverse, it's young, it's international, and we have a can-do attitude, and we have a lot of intellectual know-how. And so Rice wanted to think about how could we redirect some of the intellectual focus of Houston towards new industries and towards driving job growth. And so when we had a large land holding in Midtown, rather than selling it or simplistically developing it, we've decided to cultivate an innovation district in this area, halfway between the medical center and Rice's campus, as well as downtown Houston. And if you draw a circle around 5 miles in radius around this, there are, I think, 7 institutions of higher education within that circle. And so this is an incredibly powerful geolocation in an incredibly spread out city. And so what we're trying to do is create a place that's purpose-built to try to bring together Fortune 50, Fortune 500 companies, the university's research, as well as the entrepreneur and startup ecosystem to figure out ways that we can come together and innovate together to accelerate Houston and to accelerate solutions to these really big problems. And it's really probably not about launching an app. It's about doing the next phase, the third wave, which is hard. So interacting with highly regulated, difficult industries is the name of the game, we believe. And so that's, Rice is making a very big statement about how do we help drive that.
No, that's great, Allison. And again, we appreciate your and David Lebron, everyone else's leadership in that regard. We've got some questions from the audience coming in, so I'd like to spend the last 10 minutes going through those. And one of them is kind of an extension to you, Allison, but I'll start with Mike. And the question is, how do the panelists think about tech transfer from the large Houston universities as a focus area for driving Houston ventures? I know at Mercury, we started doing a lot of university tech transfer, which was one of my partner Dan Watkins' focuses. But, Paul, as you and I both know from early days of Genesis Park, tech transfer is hard. It's very, very hard. And it's not for the faint of heart. But Mike, I know from our pre-call, not only are you guys supporting endowed professorships, but you're trying to be a bridge to VCs who want access to the university to actually see the real hard tech and, doing the hard things. Maybe talk a little bit about that and how you guys facilitate.
Sure. Happy to, Blair. It's a good question. And look, at this point, certainly super early in my tenure at the foundation, and hopefully we can grow this over time. But right now, I view our role as as a window or gateway to the capital markets for the whole university ecosystem. And so to that end, we've had some engagement with a gentleman by the name of Andy Morris. He's the VP of Entrepreneurship and Commercialization. So that's part of the tech transfer. And he's well aware of, hey, A&M is a very bureaucratic, red tape kind of place, and it's hard for people to kind of make the connections. And what we've been able to do is connect Andy to part of the venture ecosystem. So it was 3, 4, maybe 5 months ago, we organized the call. Sandy was on the call representing HX Ventures, but we also brought 4 or 5 other VCs from our portfolio that were more than willing to kind of talk to Andy and his team about, hey, what would attract venture capital investment within the university, and how do you transfer technology and those sorts of things. And I need to do Andy justice. He wanted me to, I had a quick call with him prior to this. You guys are hosting a venture pitch competition. Hey, he and his team helped sponsor the I think it's called the Texas Venture Competition. And Andy is always looking for, participants and judges and all those sorts of things. And he's really working kind of hard to kind of start to develop that ecosystem.
Yeah.
Go ahead.
Mike, sorry.
Yeah, and I just had 2 other things to kind of share. Is the other thing we've done fairly actively is connect our folks in our VC portfolio to the university from a research perspective. Whether it's materials or education, venture capitalists and it's not just, hey, a researcher help me understand some material science complexities, but also from the education perspective, hey, as a university, how do you roll out these sorts of technologies and things to help students learn? And then we also try to provide other initiatives to the university with regards to speakers, and I think lots of people do that. But we just had one this week. One of our VCs spoke at the business school and try to motivate young people to go out and find new businesses. So that's the sort of thing we're doing right now. It's more about engagement.
Yeah, it's great. And I get lots of emails and texts from other VCs saying, hey, how do I get in front of Rice, A&M, others? And I think part of it starts with just activity, right? I mean, what Paul was talking about early on, be active in the community, that will get you on the radar. With A&M, there's the A&M New Ventures competition, and Andy Morris, who's on the board of HX, has been doing great stuff with a lot of us there. At Rice, it's the Rice Alliance, it's Lilly Labs, it's stuff that's going on with ION. But Paul, maybe you want to say a few words as well, because I know your relationship with UT over the years and everything that's happening here in the medical center. I mean, there's ways to get involved there as well on the tech transfer side.
Well, as Blair said, if anybody uses the phrase low-hanging fruit, you need to run screaming from the building, because that means they don't know how hard this is. But and he's baiting me a little bit, because he wants me to talk about the Data Sciences Institute for UT that never got to happen. Well, I remain optimistic that we can still be a data analytics hub here in Houston through other mechanisms. And again, I salute Rice's investment that Allison explained. I couldn't salute it more highly. It really, has been catalytic. So again, I don't know that I have a lot to add to this conversation other than to say the trip between venture and SPACs, I see in the margin there, we've got some questions about SPACs in the margin, and you would think, why are we talking about SPACs in a venture panel? Well, actually, the trip from venture to SPAC, as Allison mentioned, is almost instantaneous. And so at Genesis Park, we're on both sides of that equation. And so we go from despair to euphoria on about an hourly basis. The larger point is that you have to participate in markets if you do what we all do. It is so easy to say, gosh, I'm an adult, I'm a value investor, I do fundamentals, I don't understand this, I'm going to go to cash and get in a fetal position. Can't do that very long. You have to participate in the markets that you live in, and it's hard. It is hard, but I wanted to address the SPAC thing since it's sort of the elephant in the room.
No, and Paul, let me let you continue. Not on SPACs, but specifically around the greater Houston area's continued growth. I mean, I've heard you, gosh, the last 20 years talk really eloquently about what Houston's great at and how it fits into the larger ecosystem. One comment I'd like to make, and I've said this often, is everyone is very focused on Austin, which is great, right? Rising tide raises the Texas boat. But I think what people will find, because Austin wasn't deliberate in scaling its infrastructure, is that it will become like Silicon Valley, and the spillover will become like San Francisco, and that spillover will come into Houston. And so talk a little about Houston's strengths that you've seen over the years and why we can all be really, really optimistic about where we're headed.
Well, I think some of us that were in various community leadership positions, whenever that was, 6 or 7 years ago, when we were named a global city by the Brookings Institute, those people came to Houston literally hat in hand and said, we apologize. We've written off Houston for 30 years, but it's a perpetual growth machine. We don't understand how it does what it does. And obviously there's a lot of answers to that, but my basic answer is the community engagement piece is like nothing anybody's ever seen anywhere else. And that is, city government does what government has to do in law enforcement and infrastructure, but in other areas, there's a social compact here that performing arts, visual arts, alternative education, charter schools, medical research, museums and parks, all that gets privately funded by active community members. So I think that is the spirit that makes Houston as resilient as it is. Because what happened in last February, when the obviously COVID happened on the demand side, and then Russia and Saudi Arabia got in a spat on the supply side, and we all kind of looked in the mirror and said, well, we say Houston's resilient, let's see. It had better be. And it has been. It's quite amazing. Even those of us who've been watching this for a long time. So I hope that's responsive to your question. But you're right. Houston is still a city with 4 legs under it, and Austin is an interesting equation for all the reasons that you mentioned. But love Austin. Spend a lot of time there. But we are industrial and ought to be proud of that.
Absolutely. Alice and Mike, I'll kind of leave you guys with some final thoughts. So, Mike, any final thoughts for the attendees as far as Houston direction, greater Houston area? Obviously, A&M plays a huge part of that. But any thoughts that are on your mind?
To close things up, Blair, I know you're interested with a lot of fund managers on the phone, on the line. Hey, how do you get in front of somebody like us? We have 2 ways of finding funds, and one is through relationships, other GPs or placement agents that know how A&M works. The other is using databases and things like that. Always love to talk to people. The other thing I want people to kind of understand is we're not a perpetual cash machine. We have to think about programming out how we allocate capital year over year, because we can't get over our skis. And that would be a tragedy if we ever did. So we're very careful about those sorts of things.
Excellent. And Allison.
Well, I think I echo a lot of what Mike said. How do you get in touch with the endowment? Warm introductions from people we know is probably the highest probability way, and that is part of why we think of the HX Venture Fund team as being important to us. So I would say that's one path. And just understand that it is a long road. And Blair could probably second this, right? I mean, we talked for a very long time before becoming an LP with Mercury. And so that's just what the process is. However, there are tremendous things going on in Houston right now. And so I guess my ask would be get involved, figure out how you can add, whether that's in your industry, whether that's in the community. And so I loved what Paul had to say about our city. And I think we have the chance to create something uniquely Houston and uniquely diverse. And so that's important for every company to try to live up to those values.
Allison, thank you. And so to close, just want to thank Mike, Paul, and Allison for being the civic leaders they are and for all they do. And for all of the venture managers out there, I think one of the best ways to approach these individuals is not just through the foundation or the endowment, but it's by getting involved in Houston, but also getting involved with the HX Venture Fund and HX. You know, HX Venture Fund with Guillermo and Sandy and Elise just continue to be a funnel of service for us, and a lot more institutions other than Rice and A&M are leaning in and looking to them as a source for new managers and outside venture investors. So if you do that, I think you'll be in good stead. So panelists, thank you very much. And thank you to all the attendees. I look forward to a great conference. Bye-bye.